Nike's back on Amazon. Again. They changed their CEOs, they're raising their prices, and yeah, they're still making the sneakers with names like Air Max DN8. That sounds like a spaceship parts. But we're not here for the style, we're here for the money. At $60, Nike is paying a dividend yield at around 2.6%. They raised their dividend for 24 straight years, and their free cash flow positive, solid balance sheet, and a legendary brand. But revenue just fell. Earnings are down double digits. So here's the question. Is Nike a dividend buy right now or a value trap in athletic gear? Let's dig in. Where is Nike at today? Let's see the key stats. Price $60, market cap is $89 billion, PE ratio around 20, dividend yield 2.64%, dividend streak 24 years, payout ratio 51%, credit ratings A1 from Moody's, AA minus from S&P. Moody's did downgrade the outlook to negative, more on that later. Now, the PE of 20 might not scream value stock, but keep in mind for Nike that's actually below their 10-year average. So valuation wise, it's not expensive. And the 2.6% dividend yield, well, that's about average for Nike historically. They've hovered closer to 1.4%. So from yield perspective, this is actually one of the better entry points we've seen in a long time. Dividend quality check. This is where Nike shines. 24 straight years of dividend increases. Payout ratio under 60%. Currently about 51, which is very comfortable. Cash flow positive every year for over a decade. Even with earnings down, they're still generating enough free cash flow to cover the dividend with room to spare. And that's the key. I'm not just looking for a high yield, I'm looking for a company that can pay that yield for the next 20 to 30 years. Nike has the brand strengths and the financial foundation to do that. Could it yield more? Sure, but the consistency is what matters most. And don't forget, the dividend stock, timing matters. When you buy into a great company during a dip, you can lock in the same dividend someone else paid triple the price for. That's how you build real yield on cost. And if the stock appreciates over time, you're sitting on both steady income and long-term capital gains. That's the dividend investors 2-for-1 special. If you're new here, you should know something important. I only talk about time-tested, battle-proven dividend stocks. No moonshots, no meme stocks, no guessing games. Just companies with boring, predictable businesses and a track record of actually paying people like us real money every single quarter. I am talking about stocks that you can buy and hold for life and wake up at 70 years old and still getting paid. So if you are investing style too, this is your channel. Stick around. Today we're looking at Nike, NKE, a global icon, but right now kind of a puzzle. Dividend looks great, brand is strong, but growth is slowing. Financial trends: the good, the bad, and the recoverable. Okay, here's where things get little bumpy. 2025 revenue was $47 billion, down 7.3% from last year. Net income $4.5 billion, down almost 14%. EPS still positive, $3. Free cash flow around $6 billion, still strong. Let's zoom out and look at the 5-year trend to give this some context. Revenue history, you see in 2024 it's 51 billion. The year before, 51 billion. 2022, 46. 2021, 44. 2020, 37 billion. Pandemic impact. Now EPS history is on 2024 you see $3, $3.5. 2023, $3. 2022 around $3. And well, you see 2020 it was only $1.6. So yeah, recent results aren't ideal, but over the last 5 years Nike has grown both revenue and EPS steadily. Bouncing back from the pandemic dip into 2020, what we've seen now in 2025 is more of a temporary reset than a breakdown. Nike went heavy into direct-to-consumer (DTC) a few years ago, pulling back from Amazon, Foot Locker, etc. That worked until it didn't. Sales slowed, inventory piled up, margins took a hit. Now they're doing a bit of a reverse Uno. Back to Amazon, back to wholesale. It's a smart move, but it takes time. This isn't a business in decline, it's a business repositioning. That's a key distinction here. Balance sheet and debt. Nike's balance sheet is in great shape. Current ratio 2.2. Strong liquidity means they can easily meet short-term obligations. Debt to equity 0.57. Low leverage, which keeps financial risk in check. Cash on hand almost, $8.4 billion. This gives them operational flexibility and protection in downturns. Now, let's zoom out with some long-term context. Total assets. You see it's evolved from being 37 billion in 2021 to 43 billion today, slightly in decline compared to last year. Well, total liabilities, on the other hand, were $23 billion in 2021, and in 2025 again it peaked in 2024 to 27 billion, and 2025 diminished a bit to 26 billion. If you're still here with me and you're into this deep real-world dividend analysis, go ahead and hit that like button. Helps the channel, helps you, and helps fellow dividend lovers. Shareholder equity. Gradually rising from 14 billions in 2021 to nearly 17 billions in 2024, pulling back slightly in 2025. Retained earnings. Positive trend over the past decade. Proof they're not just paying dividends, but reinvesting back into business. This isn't a company overextending itself. It is growing responsibly. No dividend is being funded by excessive borrowing. It's a clean balance sheet that supports long-term stability. That's what makes Nike attractive to long-term dividend investors. Solid fundamentals, consistent execution, and enough margin of safety to handle economic headwinds. Competition check. How's Nike stack up? Let's look at some competitors. And you see the table. We are comparing Nike, Adidas, Puma, and Under Armour. Key takeaways. Nike trades at a fair multiple compared to peers. Not cheap, but justifiable given their scale. Dividend yield is one of the highest in its peer group and with a much stronger track record. Debt levels are moderate and well managed, lower than most competitors. Strategic advantages. Nike has the deepest moat, from brand equity to athlete endorsement to global retail footprint. They dominate market share in North America and hold a leading position in Europe and emerging markets. Adidas, on the other hand, had struggled with supply chain and design turnover. Puma is smaller and niche. Under Armour lacks the consistent profitability and scale. Nike isn't just playing the game, they set the tone for the whole industry. You're not buying just a shoemaker, you're buying the king of the athletic apparel. Alright, let's see what are the strengths, weaknesses, opportunities, and threats. So, the strengths. Brand is a global powerhouse. Balance sheet is clean, dividend track record is rock solid, innovation engine still runs. New shoes, collabs, athlete deals. What about the weaknesses? Well, revenue shrinking for now. Exposure to China, political plus demand risk. Executing a strategy shift mid-cycle. What are the opportunities? Well, reopened wholesale channels, that's the obvious one. Digital plus DTC, direct-to-consumer growth, and fitness tech integration, Nike Run Club, etc. Threats. Well, macroeconomic slowdown, supply chain volatility, and that NFT lawsuit from their RTFKT acquisition. Uh, what's new in 2025? Well, big changes this year. Elliot Hill is the new CEO, long time Nike executive who knows the culture. He started his position in 2024. Back on Amazon, big deal for scale and reach. Lego collaboration, it's fun and buzzworthy. Air Max DN8 release continues tech-driven innovation. RTFKT shutdown, finally, well, plus lawsuit. A distraction, but unlikely to derail fundamentals. They're making moves. It's not just damage control, it's a reset. And it might work. What about valuation ownership? Well, insider activity most selling in 2025, including $9.5 million sale by executive chairman. Institutional ownership is 67%, includes BlackRock, Vanguard, State Street. That tells me big guys still have faith, and that matters. My final verdict is Nike's hold. Not a screaming buy right now, but not something you dump either. If you already own it, great. Enjoy the dividend and watch for earnings to recover. If you're looking to enter, probably target price around $50-$55. I recently added that price range. That would give you a 3% plus dividend yield and a much better risk-reward profile. If the price runs past 75 without a turnaround, well, that's what you're consider taking profits. But if you're here for long run, it doesn't matter. You just wait years or forget about it. This is a business in transition, not in trouble. Nike fits my criteria. It's time-tested, it's dividend grower, has strong financials, and high probability it'll keep paying and raising those dividends for decades. Thanks for watching, and remember, this isn't financial advice. It's just how I think about building a portfolio that pays you for life. Up next time, stay patient, stay picky, and stay paid. If you made this far, you're clearly here for the long game. So be sure to subscribe and drop a comment. Are you buying Nike, holding, waiting for a better price? Let's compare our notes.